Hofmann and Sean Coughlin, good names, of Prudential. We are going to be talking today about the Secure Act. This is the last in our Make Your Mark series, just this quick round of the Essential and Signature series. And we really wanted to kind of end on, something that is impacting you today and really going forward. The Secure Act went into effect last December. We kind of know the implications of it now, and one thing Prudential is really going to help us with today is understand how to sell in this environment and how to communicate with the public who might not be familiar about these changes. We're going to be coming back next week with kind of a sort of an impromptu webinar about the implications of AG 49A with John Hancock. So again, this week and next week are going to be really focused on just the current climate and where we're at with specific products and specific changes in the marketplace. Nicole, we're going to get this kicked off with a few poll questions because I'm not quite sure how familiar everyone is really with the implications of this and the key takeaways that we're going to be going through later. So Nicole, you want to get that kicked off?
Yeah, just 3 easy questions. And here they go. You guys don't mind answering them? That'd be great.
Just as you answer those poll questions, one thing I want to point out is we actually just started a YouTube channel, and we're now kind of posting these webinars to send out to clients, agents, anyone that you think might benefit from this. Please go ahead and share. So we'll get that out to you probably in the next day or so. Nicole, answers coming in?
Yeah, we're good to go. So I'm sharing the results with you guys. Are you able to see it?
Yep.
Okay, so first question, are you guys familiar with the Secure Act? It looks like most of you are, which is great news. And then second question, have you guys been able to have conversations with your clients in regards to the Secure Act? Most of you also are having them. A few of you are not. So hopefully today you guys are going to be able to gain some nuggets on how to have those conversations with your clients. And then last but not least, do you know the major implications of the Secure Act and kind of how it's affecting our clients' money and whatnot. And that is about 67% of you yes, and the rest not. So I'm excited that there's some learning curves to be met here today.
Yeah, and that's going to be the key thing. We talked with Karen about this earlier, just the idea that there are major implications of this act, and if you don't know them yet, you're going to know them after this, which is exciting. Karen, thank you again so much, and Sean as well, thank you so much for joining and for really spearheading this. Yeah, we want to make this as interactive and conversational as possible. So if you have any questions for Karen, for Nicole or myself as this is going on, either raise your hand and we'll see you in the video, or send us a chat and we'll answer those immediately. But again, thank you guys so much for joining.
Yes, thanks, John. Thanks, Nicole. And yes, please ask questions as we go along. I'm going to be taking about 20 minutes and then maybe give us 10 minutes or so for questions. I'm not going to go through the entire deck because there's certain things that really don't apply to us. I really want to focus more on, like John says, the conversations, and also, how can we turn this into a life insurance sale, so that kind of thing.
Yeah.
So let's move the slide. So as you said, John, in the beginning, it was passed last year. It's a big piece of retirement legislation. And in a way, the act was designed to encourage, and this is the key here, encourage more businesses to offer retirement plans, right? Encourage more people to save for retirement. So it was a good thing. But in order to pay for this, tax-wise, right, they had to take some things away from us. And so really I'm going to focus not on this as much as what they took away, right? And now the conversations we need to have because of what they took away in order to pay for what they gave us, right? If that makes sense to everybody. So here are the key provisions, which I am not going to go through all of them. We're going to talk about really required beginning dates. We're going to talk about really focus on the elimination of the stretch. We're not going to talk about multiple employer plans or increased tax credits because, that's more group insurance. It really doesn't apply to those of us that sell life insurance. So Tax credits, I'm going to move through just so you know, there were some tax credits for employers, small businesses, great, perfect, right? But again, how do you pay for that? They had to take something away. So that's what we'll get to. Retirement plans for small businesses, wonderful. More people can participate in a plan, wonderful, great, perfect. No age limit for putting money in IRAs. And basically, if you don't know this, and if you're not familiar with this, but just so you know, your clients can actually contribute to IRAs past 70 and a half. And the reason behind that is they believe that people are not retiring at 65, they're still working. And so it makes more sense. So again, all good stuff. Increasing IRA contributions, all good stuff. Here's where I'm going to start. And this is perfect timing because we are coming up to the end of the year, right? And so the one thing that they did, which was really good, was say, hey, that 70 and a half to start taking RMDs makes no sense. I mean, who even came up with 70 and a half? What do you get a half year from, right? And John's laughing. This doesn't make any sense. So because people are not retiring early, they're living longer, it makes sense to move that out, right? So now starting this year, and this is important because we are coming up to the end of the year, you will be having conversations with clients or your agents with clients that have clients with IRAs. So the new start date is age 72. And in fact, if you don't take it in that year, the penalty is 50%, right? which is heavy. Now, why am I making such a big deal about this? Well, now the CARES Act came into play, which is the COVID-19 Relief Act. And they said, no, wait a minute, you don't have to take one this year if you don't have to. And in fact, if you already took one this year, you can put it back, right? So that was something that was floating around for a while. The date to put it back is August. So that's already passed. But believe it or not, guys, a lot of clients do not take their RMDs until the end of the year. So we do still have some time, right? And in fact, I think there's so much confusion, excuse me, my voice is gone, so much confusion over when do I need to take it? What if I was supposed to take it last year, but I waited until this year? Do I still have to take that one? If I'm 72 this year, do I still have until April 1st of next year? So there's a lot of questions. But here's the point I want to make. A couple of things. Everybody watched the debate last night, I'm sure, right? And the subject of taxes came up numerous times. I don't know how many times they were asked, are you going to cut, are you going to do away with the, Trump tax cuts, right? Everybody heard that. And so we got different answers. Here's what I want you to have conversations with your clients about. Would it make sense to take an RMD, even though you're not supposed to take an RMD until you're 72 or the year after when you April 1st of the year you turn 73? Would it make sense to go back to your clients, ages, let's say 60 and over, that have large IRAs, and say to them, would it make sense to start pulling money out now? Now, why do you think I'm bringing that up? Why do you think it would make sense to do it now?
Because there's a better place to put that money.
Well, there's also lower taxes right now. We kept hearing about the Tax Cuts and Jobs Act last night and the taxes going up. And we don't know who's going to get in. But either way, we know that there's a good likelihood if Biden gets in, they're going to take the taxes up. We know if Trump stays in at the end of 2025, his Tax Cuts and Jobs Act tax cuts are going to go back to what they were in 2017. So what I'm saying, everybody, is this is the time now where most likely if you are thinking about pulling money out of qualified accounts and putting them somewhere else, and the downside to doing that is the tax bill that you're going to pay, why not pay it now while those taxes are lower? Number one. The other thing that people don't realize is that if you delay your RMD in the future, let's just say you wait until 72 or 73, You're just making your RMD bigger, right? For the future. If you start pulling money out of IRAs or qualified accounts now, those future RMDs are going to be smaller. The other thing most people don't realize is pulling money out of IRAs is the worst thing you can do for the potential taxation of your Social Security benefits, because it pushes it up higher, so it's fully taxable. It also reduces your Medicare premiums, because again, your Medicare premiums are based on your adjusted gross income. So what I want to share with you is, where can we start looking to put those qualified monies? Because think about it, most of the money is going into IRAs. Even if they leave a company with a large 401k or a large 403b or 457, that money doesn't stay there. That money goes into an IRA, most of those, and eventually they're going to be taxed. So what I want to show you today is two strategies. One is a partial or a fully Roth conversion, and then I'm going to compare a Roth conversion to using life insurance instead. And you'll see the numbers, and it's pretty impressive. So that's kind of where we're going to go here. So let's just talk about Roth conversions. Let's just say I have a large IRA, and there's a lot of numbers on this slide, and I'm not going to go through all of them, but let's just say I have a large IRA, and let's say I'm 55. Now, I may not do this as early as 55. I may do this more at age 60 or 65, but just for illustration purposes, we use 55. My $525,000 IRA will grow, and it'll grow. And then by the time I'm 71, now I know at 72, I've got to start pulling money out, okay? I die at age 88, and after I've pulled my RMDs out and I've paid taxes on those RMDs, I'm going to leave behind $993,193 of IRA. Now, who's that going to go to? Well, let's just say if I'm married, it'll go to my spouse. But if I'm not married, or my spouse has predeceased me, it's probably going to go to one of my children, right? That's fully taxable. And when I get to some slides at the end here, you'll see that's fully taxable. And now that money, that $993,000, has to be pulled out in 10 years. No more stretch. 10 years. So my son has got to take $99,000 into income each and every year for 10 years. He might be fine with that. He might not, depending on his income, right? So I could be pushing my wealthy or high income son into a higher tax bracket. So that's number one. So let's just say instead, I took your advice. My financial advisor said, Karen, why don't you start converting it? $20,000 a year, pay the taxes on it. So now I'm moving 17.5 over to a Roth, right? And as you can see, at my death, that IRA is now only worth $306,799, but my Roth has got $1.4 million in it. Does everybody see that? Is that clear?
Yeah.
So now my son is not only going to inherit my traditional IRA, he's going to pay the taxes on 306 over a 10-year period, but he's also going to pull in 1.4 completely tax-free. So that's what we're encouraging our clients to start to do. We're encouraging our advisors to start talking about this strategy. But I want to take it a little bit further and say we can do better than this, okay? And this is what we're going to do. We're going to take that $20,000 out of the IRA, just as we were going to do with the Roth. And and we're going to pay taxes on it, but instead of putting it into a Roth IRA, we are going to put it into a second to die policy. Now, as you can see, and I'm going to compare all these numbers side by side, my son will still inherit the balance of the IRA and pay taxes on it. But now, instead of inheriting that tax-free Roth at $1.4 million, he's going to inherit a survivorship or a second to die policy at $2.1 million tax-free. So really, and again, it depends on health, it depends on age, it depends on, you know, when somebody passes away. This is just for illustration purposes. But what we're saying is if you can have a conversation about the Roth conversion strategy, which I believe you should be having, you should also be having the same conversation to see if we can just make it better, right? There's no difference between moving it to a Roth or moving it into a life insurance policy. They're both going to be tax-free to the beneficiaries, but we know because of leverage, the life insurance policy is going to basically pass on more than the Roth. Correct?
Karen,
Yeah.
let me pause you just for one sec. Just want to say, Brett, thank you so much. You posted some great facts down and links down in the chat function. If anyone wants to take a look at kind of where the tax rates are now and where they've been traditionally and where they're going. Karen, I just wanted to interrupt you real quick because, you know, one of the things that we talk a lot about at Watermark Life is, you know, selling to clients using essentially logic versus emotion, or using their head versus their heart. And I hear what you're talking about here, and this seems like such an easy conversation that it has nothing to do about, you know, ambitions and goals and, you know, protection and all that. This is a very straightforward, logical, hey, you know, dollars and cents. You know, when you, Karen, talk about those real world applications and you're talking to clients, to me, this seems like a pretty easy pitch. It's just about knowing this exists, right? And knowing how this works.
Right.
And so Karen, if you can touch on that, and then if you see in the chat function, there was a question that just popped in. Do you see that right there?
Yeah. Do you want to read it to me? Can you read it to me? Because it's a little,
Yeah, it just states, is a survivorship universal life policy an IUL? And it could be either to answer that question.
Yeah.
I'm almost positive that Prudential specifically has a guaranteed universal life survivorship product, and a survivorship index universal life product as well. So
yeah. And just remember, when we do these presentations, we don't really, you know, relate to a specific product. You know, that would be between you. You know, you would decide on that. We just sort of show the strategy. You know, it could be, because you never know, things change. So moving along here. No, going back to what you just said. One other thing I like to point out, and I always like to identify the right client. So let's go back to who would be the right client. This is a client very specifically that has a large IRA or qualified plan that's going to go into an IRA. But what they would have to have is, one, no need for the RMD. Okay, they don't want to spend it. This is not something they're going to spend. They have other income, right? They don't want the RMD because they don't want to pay the taxes on it, or they don't really plan on pulling money out of the IRA unless they have to. They really want to leave the IRA, and you'll see this in another slide. They really want to leave the IRA to their kids and grandkids, right? If this client is like, oh no, I don't care if they get it taxable or tax-free, it doesn't matter to me, that's not the client we're going to be talking to. If that client is the one that says, I want my last check to bounce, right? That's not the client we're talking to, right? And we know they're out there.
I like that client though.
I always use that line because I heard somebody once say that to me and I couldn't believe he said that.
That's so funny.
Yeah. So anyway, so moving on, and I just want to sort of, let me just move the slides over. Let's just look again, the two of these side by side. Now, if you were to show a client this and say, pick one, right? And again, remember, this client is generous. They love their kids. They love their grandkids. They want to leave something behind. They're really concerned about taxes in the future, right? They really think it's going to be horrible, right? They're really concerned about the future of their kids and grandkids, what's going on in the world, right? And you would just show them, look, you know, you can see the Roth, you can see what's left of the traditional IRA, less the taxes, right? We just took a 24% tax rate, which is pretty conservative. And we just said, look, we reinvested the RMDs because we didn't need them. Here's how the two side by side look. And as you can see, one is going to give the kids or the grandkids, you know, close to $600,000 more by doing this versus this. So instead of putting it into a Roth, I'm just putting it into a life insurance policy. That's it, right? So it's all about the taxes. It's not about the life insurance, or I don't need the life insurance. Who doesn't need the life insurance? It's about the taxes, right? So, you know, I'm going to skip this slide, using RMDs to fund conversions. I really don't want to get into this. I don't want to spend too much time, but there is ways to fund your conversion using the actual RMD itself. So you take the RMD out and then you use whatever that RMD amount will help pay the taxes. So you're kind of pulling it out, putting it back kind of thing, but I don't want to spend too much time there. I want to get into the stretch, right? I want to get into the stretch again. I'm going to again move my slides over. This is another conversation, again, you should be having with your clients about passing on or legacy planning. I alluded to it before, but no more stretch. Any beneficiary, which is with the exception of a spouse, somebody that's chronically ill, or a minor child, now only has a 10-year payout period, right? And so that's going to hurt a lot of beneficiaries, because they're going to, like I said, it's going to hurt them tax-wise, because, you know, in the past you had 30 years to pay the taxes. Now you have 10, right? So that's a conversation to be had. And then here, I just want to show you one thing, and this is really surprising to me. And you may know this already. 94% of IRA owners only took their RMD. Why? They don't need the money and they don't want to pay the taxes. So wouldn't it make sense for us to have a conversation with those 94% of IRA owners and say, if you're only taking the RMD, why, you know, why? Could we take this asset and make it tax-free, not only for you, but also for your kids and your grandkids, if you're not spending it, right? And when we do the strategies, when we talk about the strategies, we're not talking about taking the entire IRA and paying the whole taxes on it. We're only talking about taking a little bit and moving it slowly, right? So it doesn't hurt us so much. So here's another couple of examples I've got. This is very, John, Nicole, this is a very common case I get in the advanced planning team. I get them all the time. I mean, every week I'll get a case like this. They've got $1.5 million in their IRA, right? And people often ask me, well, how do you get that much money in your IRA, only putting like $7,000 in it? No, it was rolled over from a pension plan. It was rolled over from a 401k. That's how you get that much money. So they're doing well. They've got $1 million in investment assets. They have pension plan, a defined benefit pension plan, which they're really lucky. And they have other income from other assets, and they really don't want to touch the IRA because it hurts them tax-wise. But they have told you they're going to leave $500,000 of that IRA as legacy money to their daughter. They only have one, Barbara, right? And so here's the old example. Barbara would have inherited that IRA, and she would have had 30-something years to stretch it. And you can see that that IRA when mom and dad passed away was worth $691. And by the time Barbara passed away, she would have taken out $1.7 million from the IRA by doing the stretch based on her life expectancy and basically spreading the taxes out, right? No, that's gone. That is no more. Those are the old rules, right? And so now if we look at the Secure Act, there's a couple of choices that Barbara now has. Barbara can take the whole thing, pay the taxes, and again, we used a 31% tax bracket, and she would now net $475,000, right? Or Barbara could do the 10-year payout, right? Take it over 10 years, and she would net $600,000 versus what she would have gotten under the old stretch. Does everybody see that? Yeah. It's significant. This is a significant conversation that we would be having. And again, those conversations are with the beneficiaries as well, not just with the clients, right? So it's hurt us. And the reason for this is quite simple. They want the revenue. They don't want Barbara to spread the taxes out over 30 years. They want the money now, right? And it's only going to get worse. I mean, we may see this now be a 5-year payout. or maybe we'll have no stretch at all and it's all paid lump sum, right? So, you know, again, let's just assume we've got, you know, the same situation, and Don and Kathy pass away in their 80s and they leave their IRA to Barbara, and let's just say the IRA is growing at 5%, but instead they take your advice and they redirect $20,000 into a survivorship life insurance policy, and now Barbara doesn't get the 475 or the 600. Barbara gets whatever's left plus 1.4 million in tax-free death benefit, right? By doing nothing more than moving $20,000 a year into this, right? So it's pretty simple. Now, let's take a look at the numbers. The Secure Act, after the Secure Act, the 475 with what we call the asset protection strategy is moving that 20,000, paying the taxes on what's left of the IRA, and then collecting the tax-free death benefit. This is a difference to Barbara of $1.2 million tax-free. It's a no-brainer to me, yeah. Right? And anybody on the phone, but obviously explaining it to a client. So just, let's go back to explaining it to a client. We can run the numbers for you. John, I don't know if you know this. Sean, you know this. We have software approved that will show before and after. Roth strategy, life strategy. We can run them side by side. We can run the Roth strategy and the life strategy, or just the life strategy. We can run how it would look like this. I'm just trying to think if I have it. Kind of looks. Let's see. Kind of looks. It's a ledger. I don't know if you can't see it, but it's really nice. It's very professionally put together. It'll say the client's name on it, prepared for, and it'll show those numbers in detail or as less detail as you want.
Karen, let me cut you off for 1 second.
Yeah.
And I don't know if this is something that you know or if Sean knows, but is that co-brandable so Watermark or individual agents could have their names on it as well?
I believe we are looking at that. I don't remember because we're working with a vendor, so it might be a little different. I'm going to say, John, I don't know. Sean, do you know?
I don't think it does right now. Yeah, I think we're working on something soon.
Okay.
Yeah, but just know that's there available, because, you know, again, a lot of advisors are saying to me, well, Karen, this sounds great, but now I got to explain it to somebody, you know. Yeah. And if I've got clients that are number people, you know, a slide like this isn't going to cut it. They're going to want to see their real numbers and their real situation. So anyway, couple things. Let me just check on time here, just make sure I'm okay. Almost there. All I would like you to do, a couple things, is I'd like you to go through your book of business and pick out any clients that you know have left an IRA, made a trust the beneficiary of an IRA. There is a lot, because they want the benefit of the stretch, but they also want the benefit of the protection of the trust. Meaning, I don't want the kids going to Vegas with the money. You know, I want to be able to protect that IRA from my children. So you may have in your book, have trusts as beneficiaries of IRAs. You need to revisit with those clients. You need to go back and explain that the 10-year stretch is the only thing now this trust has. And so if they were relying on a trust to protect the IRA for 30 years, it's not going to happen. And the other thing is that if they have a trust where the trust actually takes the RMD in and leaves the RMD inside of the trust, let's just say that one of the kids is getting divorced, somebody's going through a bankruptcy. Also remember that trust tax rates are ugly. You pay the 37% highest marginal rate inside of a trust at $12,950 of income. So again, they may want to revisit, go back to their attorneys and redraft these trusts or change them so the trust isn't what they call an accumulation trust. They change it to what's called a conduit trust, which means that the RMD has to be paid out, but it protects the entire, the rest of the IRA, if that makes sense. So just point that out. A couple of other things I'm seeing a lot of these cases coming in where instead of the 10-year stretch, we actually make a CRT, which is a charitable remainder trust, the beneficiary of an IRA. The difference here is that now this allows it to be stretched over a longer period of time, 20 years versus 10. But this is complicated. You'd need a CRT company to get involved. You'd need a lot more administration of these. But this is coming up. I'm getting calls on it. So but at the end, you would have to leave part of it to charity. But the sale here, the life insurance sale is whatever goes to charity, we replace what the kids aren't going to get with life insurance. So even though tax-wise it's good for them, tax-wise it's better for the kids for the stretch, but some of it is going to charity, period. So if they're not charitably inclined, they don't want to leave part of it to charity, this isn't going to work. But again, there's always a life insurance sale involved here for what the kids don't get and what goes to charity. So I'm not going to go through any more of these slides. I just want to give you the ultimate, at the end of the day, numbers. All right, so everything I just talked about, don't get hung up in the numbers. Look at the right side of the screen. Here's how it works. The repealed stretch, right, that's gone, would have left 1.7. The charitable remainder trust would have left 1.6. The new Secure Act 10-year rule would have left 1.1. And again, this is total distribution. The serial Roth conversion, 2.7. All said and done, the asset repositioning with life insurance, and again, I showed you lots of different scenarios. At the end of the day, 4.1. So whatever one you look at, whatever one the client wants to do, the life insurance asset repositioning strategy is always going to be more, always, because of the leverage, right? You've got the leverage of the life insurance. So again, if I were a client and you were sitting down and saying which one is the best one, obviously I'm going to go to the one at the bottom. So that's it, John. We can open up for questions.
Yeah, well, one thing, Karen, I just want to talk a little bit about right now, and it's something that you touched on earlier. It's the idea of figuring out which clients this works for. And to me, that's another classic example of the importance of really knowing your book and understanding where people are at different parts of their lives. I mean, knowing that in advance is almost more than half the battle, really. Especially when you have products like these or strategies like these that are just so logic based and just so number figure based. I mean, if you go to the wrong person with this, who doesn't have enough money or isn't charitably inclined, like you were saying for that one strategy, or that great, I want to bounce my last check. Yeah. If you go to them with this, you're wasting your time. But if you go to the right person with this, it's almost, I don't want to say guaranteed sale, but it's like, how do you turn down logic like this, right? So if there are any questions, I think Brett, you had a question. Karen, I don't know if you saw this. Do we have to request those illustrate? I think the dollar comparisons.
Yep.
From the advanced markets desk, or is that something that we can run ourselves and clients can run themselves?
So at this time, we have one person on my team that doesn't. And so go through Sean. Sean, it's Matt Fitch is the one that is in charge of this, designed it, and runs the whole thing. Yeah, we've been working hard for many years on this, and we've got more to come. We've got lots more strategies, but we started out with these because these are the ones we were asking for the most. Yeah,
gotcha. Sean, I'm going to turn it over to you for the last part of the presentation.
Okay.
And are you able to share your screen, or Nicole, are you going to share your screen?
I think I've got to stop sharing. Hang on.
Oh, gotcha.
I'm swapping it right now.
You see my screen?
Yep.
Blow this up. Can everybody see this?
Yep.
Okay, great. Thanks, Nicole. Thanks, John. So I'm going to take a few minutes to talk about something that used to be a niche, but really now it's become a program at Prudential. And we've been able to have a really, really large impact with advisors and their clients. And so the topic today for the next couple of minutes is loan rescue. Others of you may know it as mirrored loans. They're kind of interchangeable with us. What we're talking about is taking highly leveraged whole life policies, repositioning them into a Pru policy. And that policy might provide more death benefit, better guarantees, maybe additional riders, might be less expensive. And it also might give us the ability to eliminate or minimize a loan. And so what I'm going to do is go over a little bit of a historical perspective, a little bit of background and why you would want to do this, a case study briefly, and then, why Pru and what are some of the next steps. So first off, why would you want to do this, and what, what's the background that we're talking about with loan rescue? It's no surprise that we are in a low interest rate environment, and we've been in one for the last 10 years, and we're probably going to be in one for the foreseeable future. And what that's done is that's also, as interest rates have gone down, that has also affected dividend rates in whole life policies specifically. And so the expectations that were set with whole life policies, 10, 15, 20 years ago are quite a bit different than the reality right now. As many of you probably know, that dividends and interest rates, generally they're mirrored. There's always a little bit of a lag with dividend rates, but they have a similar, they're correlated. And so what's happened is, as dividends have gone down, you've seen a reduction in policy performance for a whole life contract. And so in addition to that, we also have a problem with compounding loans in whole life contracts. And so what do I mean by that? So loans can be accounted for in two ways. One of them is the way that we all know, where I want money, I want to take out cash to, for a down payment on a house, and I go in and I take a loan out and I've got cash on hand. I actually recognize that. I took the cash out and I did something with it. The second way of getting a loan on your whole life contract is really specific to whole life policies. So, a typical scenario might be if I bought my policy 20 years ago, and at the current dividend rates at that time, say in 2000 were, it was pretty common. The dividend rates were anywhere, between 7 and 8%. And I was told at that time, Sean, if you pay this premium for 10 years, you can stop paying premiums. So maybe I paid my premium as it was anticipated, as designed. And in year 11, I stopped paying premiums. What happens is with a whole life contract, as when you stop paying premiums, you actually go on something called automatic premium loan. So each subsequent premium that you don't make is actually accounted for as a loan in your contract. So the client oftentimes has no idea that this is going on. And so what's happening is each subsequent missed premium is being accounted for as a loan. So there's a $10,000 premium payment with interest, and then another $10,000 premium payment with interest. And so what can happen is, that agent that sold me the policy in 2000, they may have retired, they may not be in the business. That policy may not have been reviewed for many, many years. And now you come in and you see that, without me knowing it, that I may have accumulated a substantial loan over the last 20 years in my policy. With interest, there may be a sizable gain in that contract. And unbeknownst to me, I may have a large out-of-pocket coming due. And so at a certain point, because dividend rates have gone down so much, and because clients have been accumulating loans with high interest rates, there may be a time where they not only need to pay the base premium to keep that policy in force, but interest as well. And you're talking about something that could be an exorbitant amount of out-of-pocket costs that most clients simply can't afford to pay. And so you all have probably heard the term phantom income, and that's where phantom income comes from, right? Where a policy may have lapsed due to it being highly loaned. Your client gets a 1099 and they never took a dollar out from their policy, right? So at least if I took a loan out in another type of contract, whether it was an indexed UL or a VUL, at least I actually took cash out and I used it for something. But on a whole life policy, it's entirely possible that if your policy lapsed, your client got a 1099 and they never got any benefit from what that 1099 came from. So so really there's a couple of things that can happen if you run into, and the idea here is ultimately to find a case to work on, but I'll go over some of the options of what you can do, what the options are if you come into a policy with a large, that's highly leveraged that has a loan. You can really do three things. One is you can do nothing, right? And that may be entirely possible depending on the facts and circumstances of the client. They may be, whether if they had health issues, they may not be able to qualify. There may be a substantial amount of cash relative to the loan where, there really just isn't the need. However, you could be taking a manageable situation, as we see in a second, and turning it into something that's unmanageable. So you could be potentially taking your chances by doing nothing. The second one is by paying down the loan or paying down all of it or a portion of it. And the problem with that typically is that you're talking about loans that could be on average, $300,000, $400,000, $500,000. And so that just may not be feasible for most people. And then the third option is doing a 1035 where we're actually mirroring the loan and bringing over the cash value from the existing contract and bringing that over to Pru. Once that comes over, we even have a way where we can actually pay off the loan with your cost basis without taking a dollar out of your pocket. We just basically take the cost basis from your left pocket and we move it to pay off the loan in your right pocket. So we're able to extinguish or minimize the loan and to potentially do that, as I said before, without a dollar of out of pocket. And so let's go through a quick case study. And again, these can get very granular. So I want to just show you kind of a before and after picture. And I always tell people that really the best way to learn the mechanics is really just to have a case to work on. So what we have here, and this actually was a live case from years ago, but Scott Stevens, who's 50, he purchased the policy 23 years ago and paid his premium for 15 years and then went on an automatic premium loan unbeknownst to him. And so what's happened is, like with many clients, is that when they took out the policy, their situation was a bit different than what it is now. Daughter went to college. He wanted to fund his retirement plan and didn't want to continue to pay for coverage out of pocket. So on the left side is what he started out with. He started out with $3.87 million of death benefit, $885 of cash value, $240 of a loan, and $525,000 of cost basis and 6% interest. Now, this situation is one of those that it's not dire right now. Is this urgent that he moves his policy to something else? No, he's got plenty of cash value relative to a loan. However, that $240,000 loan could continue. If he just ceases permanently to pay premiums, that $240,000 of a loan in 10 years could be $600,000 of a loan, right? And that cost basis of $525,000. Right now he's got a $600,000 gain already, and if you postpone into repairing this in 10 years, that the gains in this contract could be dramatically more, and depending on dividend rates, and ultimately, the cost to keep this policy in force could be exorbitant. He may have a problem, he may not. We don't know. And on the left side, you can also see that there was a 6% loan interest charge. And so what we did in this case is we actually 1035 the loan and the cash value over to a Prudential policy. And it really doesn't, this one was using VUL, but we actually do most of our cases with an indexed UL. That's typically the engine, but by mirroring the loan, we brought over the same $240,000 loan. We didn't leave that at the old company. We also carried over the cost basis of $525,000. But what we did is we also lowered the interest charged from the old contract at 6% to 2%. So think of this as, right now everybody and their brother is refinancing their mortgages. There's really no difference, right? You're refinancing your life insurance policy for a lower interest rate. So you are actually getting significantly better terms on the loan interest charge. All right, so what's the end result here? We took the client from $3.8 million of death benefit to $4.8 million. We reduced the loan interest charge from 6% to 2%. We gave the client actually a 33-year death benefit guarantee. And what we also did was we were able to take this cost basis, and with Pru, what we did was we took a withdrawal of the cost basis. So what we do is we look at that loan, and in year 2, all we do is we make a withdrawal of your cost basis equal to your loan. So we're moving the cost basis in your left pocket to pay off the loan in your right pocket. You're not paying anything directly out of your bank account. This is just kind of moving more of an accounting practice at Pru. And now you have a policy with no loan. Okay. And so, now the client is in a significantly better position than what they were before. But even if they didn't want to take that money out to pay off the loan, we've saved them 4% on that $240,000, which is meaningful. It's almost $10,000 a year, even if they didn't pay off that loan. Does that make sense so far?
Yeah.
Okay. All right. So let's go to, why would you want to do this with Prudential? There's a couple of reasons. One of those is that, this is something that we've been doing for a long time, and we are known in the marketplace for doing loan rescue or mirrored loans. As you can see on this, the before and after, there are some granular details that you have to go through. And so we're used to running these, and we work on behalf of Watermark and with Watermark to craft a solution that fits with your client. Secondly, the loan ratio. Many people always ask, what's your loan ratio? And we don't really have a set one. We've taken loans up to, 85%. But we do have, we still have to be able to run the illustration. They still have to get corporate approval. The one set in stone requirement we have is that $25,000 of minimum cash value has to come over. And what I would tell you is that some of the best cases we've done are cases where the client had a huge loan relative to the cash value, which brings me to my next point, which is we actually pay compensation on the total account value, not just the cash value. So we had a case recently where we had $40,000 of cash and $200,000 of a loan. Most carriers will only pay compensation on the $40,000 of cash, but we paid it on the total account value. So it was $40,000 of cash plus $200,000 of a loan. So that was a $240,000 1035. So you do get paid for your time. You might have to put a little more elbow grease into this, but we certainly, you get paid for your time, and there's significant benefits that can be, certainly provided to your client. And we have a pretty robust portfolio of products of which to use, whether it's a single life or second to die. We do typically use low-cost IUL products. And really what we want the advisor to do is, your job is really to get an up-to-date in-force illustration or cash value statement, and to identify the client's objectives. Do they want to keep the same death benefit? Do they really just want to prevent a 1099? Do they want a combination of both? What is their budget to keep this policy in force? That's really what your goal is, and then we can work our way backwards with, with Watermark to craft a solution that fits your client's needs. So, in summary, we talked about historical perspective, that dividend rates are connected to a low interest rate environment, and that has negatively impacted whole life contracts. Talked about, we went through a case study where we took where the client was before and where they are now. We gave them significantly more death benefit, better loan terms, less expensive policy, and we also paid off the loan with no out of pocket. And we also talked about why Pru. Right? And so, what's the motivation for people to do loan rescue? Well, first of all, you can save a client a huge taxable event, right? We've had, we had a case last year, the largest case we've done, that was, I think it was a $9 million loan, and there was a $4.5 million taxable event. I don't care how wealthy you are, that's a significant taxable event, but we do a lot of them where the taxable event might be 50 to 100,000. And that's a meaningful amount, that's a meaningful amount of taxes for most people. Yeah. And so the idea for some, their goal is just to prevent that from happening, and we can craft a policy with watermark just to, to prevent that. So it really just depends on the client needs. You can, obviously preserve the insurance. Many clients have no idea that they're in this kind of situation, and they really do want to maintain the insurance, and they have no idea that the loans have eaten away at that death benefit. You can make a friend with the CPA. If those policies lapse, the CPAs are really going to be stuck with the 1099, and they're going to have to, figure out a way to account for that. And hopefully, the client has enough deductions, but they're going to have to get creative. And lastly, obviously, we've talked before that, these are nice cases. The average case within the company is probably, I think, about $40,000 of comp. So you do get paid for your day. So it's a win-win situation for both the client and for both you. And so what we really want to ask you is over the next 30 days, we'd like every advisor to just ask each of your clients, do they have any old whole life contracts? Many clients that have these policies, it's amazing that they do not assume, they don't think of a paid up whole life contract or a whole life contract that they have been paying premiums on for a long time. They don't associate that with their typical insurance. But so oftentimes you need to specifically ask them because maybe they were gifted a policy from their parents or grandparents. It has a substantial amount of cash in there. Maybe they've taken some loans and they just simply don't know the ramifications of that. So we want everybody to go around, make sure that all of your clients are aware that you can, do something with their old whole life contracts and really just ask the question. And also to make sure that any CPAs you work with, that they're also aware of that too. CPAs are typically great sources for loan rescue cases because they may have referred out, years ago, a whole life carrier. And they also may be the ones that are stuck with the 1099. And if you can repair that, you might be making a friend with the CPA that shows that you can add value to any additional clients that they may have. So with that, I want to thank everyone for allowing Karen and I to speak today, and Nicole and John, thank you again, and we will turn it back to you.
Sean, we appreciate that so much, and your insight into this, and really just these advanced strategies are, they're so helpful. And to me, the big takeaway above everything is the idea of knowing who your clients are, staying up to date with them, and being able to kind of translate what's happening in, the world and the implications of, new regulations, new changes, and how that can impact them. Karen had to hop off for another webinar that she's presenting, I think at 11. So we're going to wrap this up. Nicole, thank you so much for setting these all up. We're going to come back next week, Nicole, with a review of the AG 49A implications with John Hancock. And we're going to send out invites to that. And we're also going to send out a recording of this if you want to share it with anyone. Again, to Prudential, Karen and Sean, thank you so much for your time. And thank you so much to everyone for joining.
Thank you.
Have a great day.